Hey, Saretsky here. Welcome back to the show. Lots to touch on this week. We've got some updates from the Bank of Canada, a rate announcement from the BOC. Going to walk you through some of those comments. We've got an update on the labor market, which of course is incredibly important to be following along over concerns about job layoffs in coinciding with the tariff war. Going to walk you through some of that data. And then, of course, what's happening in the local housing market. We've got May housing stats, things that we're going to watch moving forward, and why I believe June and heading into the summer months might actually be busier than some people expect. So again, I'm going to kind of wrap all that together in this week's video. But first and foremost, have to talk about the Bank of Canada. Everyone's been paying close attention to Tim Macklem. Again, coming into the BOC meeting, the expectation this year was 50 basis points of cuts throughout the back half of this year. The market had not expected the Bank of Canada to cut rates in this June meeting. And that's exactly what they did. They did not cut rates. They held rates, basically saying in summary that they are going to be data dependent, and they're really no rush to continue to cut rates. They want to see how the tariff stuff plays out, and which, I mean, logically makes sense. Typically, central banks want to be forward looking. They want to look in advance and start making, changes or pivots in advance of data that might come out. But I mean, it's pretty hard to be forward looking when you have, Trump in the White House that is changing policy pretty much on a daily basis. And so they're basically in a wait and see mode, wait and see what happens with the tariffs, wait and see what happens with the data. And that's why they kept rates on hold. Post that meeting and some of the data this week, markets have actually priced out some further easing from the Bank of Canada. So again, they were pricing in about 50 basis points of cuts this year. That's now down to about 35, or basically a coin toss between whether it's one cut or two cuts in the back half of this year. And of course, the direction of those future rate cuts, which impacts your variable rate mortgages, is ultimately going to come down to the tariff war and really in particular the labor market. I mean, if you think about stressors that can add to housing, and the one thing that keeps bankers up at night the most, it's not necessarily rising rates, it's actually unemployment or job losses. Job losses, I mean, it's pretty hard to service a mortgage if you have no job and no income to service that mortgage. And that's where you start to see, obviously, the rise in defaults. So you got to keep an eye on the labor market. Again, you can have rates down to zero, but if you don't have a job to borrow the mortgage or the credit, it really makes no difference. And so the labor market is the one to watch. You had data coming out from Stats Canada. That was now the third consecutive month that the unemployment rate has risen. It is now at the highest levels since September 26 outside of the pandemic. So outside, you strip out the pandemic, it's the highest unemployment rate we've seen since September of 2020, September 2016. So the unemployment rate now sitting at 7% and almost certainly going to rise from here as we see the sort of onset of this the tariff wars. We see businesses and companies starting to pull back. So that's obviously incredibly important for the housing market. I think what we're seeing, at least what I see on a day-to-day sort of anecdotal in the market, is the biggest thing that's holding people back. I mean, it's not mortgage rates. Mortgage rates are sitting at about 4% today, which is exactly where they were when the market was busy, or relatively busy in Q4 of 2024 into the early days of Q1 2025. The market was moving relatively okay. It's really the uncertainty around the tariff war and, of course, your job prospects that has pushed all these buyers onto the sidelines, not wanting to step up and actually write offers. That's what we're seeing. And so it's the uncertainty about the future outlook for the labor market. And again, as we're seeing that unemployment rate rise, that starts to, of course, add to further concern. So I found the one thing that was most interesting on the labor market data we've been talking about a lot on the show is really the surge or the bonanza in immigration, right? We know of the federal government unleashed the immigration taps over the last couple of years. And again, remember, at one point, I think it was in 21 and 22, we had over 1 million people a year, up to 1.2 million new immigrants coming into Canada. Running at the fastest rate in nearly 70 years. So what we're seeing basically is all these sort of low-skilled immigrants that have come into the country through various programs, whether it be student visas, temporary work visas. A lot of them sort of these bogus policies that were in place that facilitated record immigration is they've actually displaced, again, keep in mind that low skilled immigrants in many of these circumstances, they've been displacing Canada's youth. So the Canadian youth is actually the one that's been most impacted throughout this whole immigration boondoggle. So the unemployment rate amongst returning students age 15 to 24, the unemployment rate for these individuals sits at 20%. 20% unemployment rate for students aged 15 to 24. That's up dramatically from 11.4% in May of 2022. And that's from Stats Canada. So this is where the crisis is. And this is why I think you saw in the federal election the divide between the sort of the millennial and the boomer. I mean, the boomers have largely been insulated through this immigration policy. In fact, they've actually benefited through higher home prices. It's been the youth that not only got priced out of resale home purchases, but their rents shot up and they can no longer find jobs. And so that's been the cohort that's been most impacted. And that's now showing up in StatsCan data, which ultimately leads us into the housing market. You look at rates, you look at the labor market, what's happening in the housing market. Well, home sales here in Greater Vancouver outside of May 2020. May 2020 was the onset of the pandemic. The economy was basically like literally shut down. People were trapped in their homes. So outside of May 2020, it's the fewest home sales for the month of May in 20 years, a 20-year low in home sales in Greater Vancouver outside of May 2020. So the demand is incredibly weak. I think that demand is going to pick up because, truthfully, it has nowhere to go but up. When you have 20-year lows, again, start adjusting for population. That really tells you how weak sales have been. There's only one way to go from there. I think as people sort of start to digest the tariff stuff, we're actually starting to see it in the marketplace now over the last 1 to 2 weeks. Is people slowly coming off the sidelines. Again, not saying the market is hot or dramatically picking up, just it's coming off a low base, a very, very low base, and starting to increase. We're starting to get some stale listings that are finally starting to move, and it's going to take time now to clear that inventory. You've got in the condo segment, for example, you've got nearly 8 months of inventory for sale in the resale market, about 7.6 months of inventory in the condo market. If you look at standing inventory, so standing inventory, which is the number of condos currently for sale on the MLS system, you've got a 15-year high for the month of May. You've got a 15-year high for the month of May. So that's really what's happening. Obviously, that's putting downwards pressure on pricing. It's a very, very illiquid market. So it's actually very hard to put pricing on it. Like if you look at the MLS home price index for condos is down 2.5% year over year. But in reality, it's moved much more than that. I would say you're seeing a 5% decline, and in some cases, it's upwards of 10% over the last year because you're in this liquid market where we're seeing units, real life examples where, a unit in the building might have traded, let's say, 6 months ago at 725. You then say, okay, well, I've got the identical unit. That one just traded 6 months ago at 725. Let's price it at 729 in hopes that we get maybe 720. It sits there, you reduce, you then take it off the market, you do a relist at 699. It still sits there, you reduce again to 679, still sits there, no offers. And you're kind of like, well, what is the price that this needs to be lowered to in order to actually clear the market? And so it's actually it is a moving target because when you get into these illiquid markets in segments, I should emphasize in segments, particularly these sort of smaller one-bed condos in areas like downtown Vancouver, Brentwood in Burnaby, where you've got it's just a plethora of new supply flooding the market. Places like Surrey City Central, where again, just tons of inventory in those segments, actually all-time record high inventory levels in those segments. It's hard to figure out what that clearance price is. Again, 6 months ago might have traded at 725, and that market now might gap down to a 650. in a span of just 6 months because there's no bid, there's no liquidity that if you actually want out, that might be your clearance price to get somebody to step up to the table. So again, I should emphasize that's really only in certain pockets of the market. You look at pockets of, let's say an entry level move in ready single family house at the entry level price points in certain markets. I mean, those are still moving. And in some cases, rare cases, you might actually still end up competing on that home. So it's not selling for the record prices it was 2 or 3 years ago, but those segments are still moving relatively well. And you have other segments that are completely illiquid. And of course, we continue to emphasize on the show the weakness that is pervasive in the condo market, particularly the new condo market. Um, we're watching a record number of units that will be completing over the next 12 to 18 months. We're hearing more and more stories of appraisals coming in short, units that were purchased in pre-construction in 21, 22, 23 that will be coming up for completion very soon that are now getting appraisals. And those appraisals are coming, 5 to 10% below, um, in most cases, 5 to 10% below what they were entered into in the pre-construction side 21, 22. And again, that might not sound a lot like, 5 to 10% off, but that's a big margin call to some extent for that purchaser. They have to now come up with that shortfall on that appraisal. You have to come up with the excess cash. And not only that, but your mortgage rate, when you entered into that contract was 2%. Today you're borrowing at 4. So there's a sudden sort of financial shock for a lot of these pre-sale investors or pre-sale owners that are going to be completing very, very soon. So that's kind of the data that we're watching moving forward. Starting to see a little bit of uptick in sales activity, which really should not be surprising given that you're at 20-year lows. Tariff stuff is slowly going to digest itself, but the thing we continue to monitor is obviously the unemployment rate, which is moving higher, and I suspect will continue to move higher, and that should keep the Bank of Canada on their toes, and we'll see how market pricing adjusts to that accordingly. So, as always, I hope that helped, and we'll see you next week.